quite significantly in that case.
Fair enough. Well, Sanjeev, on the whole, your portfolio, is it still very IT defensive oriented? What is the percentage of IT pharma? What is the percentage of cyclicals?
Well, it's not as oriented towards IT and pharma. It used to be, let's say, even 3 months back. Over the last, let's say, 9 months, starting from April, we have been very heavily biased towards outsourcing names, such as IT, pharma, Mother Sutsumi, Tata Motors, those kind of names. But in the last 2 months, I have been starting to gradually reduce the positions in the pharma sector, definitely. And now we are more or less neutral as far as the pharma sector is concerned. IT we still are overweight because we still see value in some of the names over there. But I think broadly speaking, for most of the IT pharma names, I think fiscal 2015 is more or less discounted. One will still make money in the stocks because, the stocks will deliver earnings growth over a period of time. But I think now whenever people start focusing on fiscal 2016 numbers, which is I think still, 12-15 months away, you could still make some money, based on rollover. But having said that, I think now the returns from these stocks will be more or less in line with the cost of equity, maybe 12 to 15% annual return, which I don't think is very exciting. The scope for re-rating is somewhat limited. So accordingly, we have reduced the weights in some of this IT pharma sectors and increased the weight on some of the domestic cyclical names such as banking. So we are somewhat overweight on the private banks now. Auto is a big overweight for us now because we are looking at an economic recovery maybe 6-9 months down the line. And also we have taken some positions in some of the PSU energy names, anticipating diesel deregulation will continue. Whichever new government comes to power will probably have to address that situation. Fiscal deficit won't change unless and until diesel prices get deregulated. So that's a risk we are willing to take at this point in time, given the risk-reward balance is, at least on paper, quite attractive for the PSU energy names.
A stock that's in focus this morning, Sanjeev, is Bharti Infratel on the back of that RelGeo pact sharing. We don't actually know the quantum of how much the tenancy could improve because the deal size has not been disclosed. But how would you approach that stock, and would you advise investors to buy it now?
No, this has been a stock which has been in our portfolio for some time actually. We put it at about 150 levels, and now it is probably headed more or less towards fair value. Our fair value is 200, the stock is about 190, 195, so not much of upside, but I think the long-term prospects of this company are still quite attractive in the sense, it's a nice business, as Reliance or some of the existing players, keep on expanding their operations, this company will, continue to grow. It's also starting to generate a fair amount of free cash flow. If I remember the numbers correctly, it's generating about 22-23 billion rupees of free cash flow per annum, which is quite an attractive yield in that sense. So I think maybe the immediate upside is done with. The stock has obviously done very well over the last few months. But I think it's still a stock you can own, it's generating a fair amount of free cash flow. The company can ramp up the dividend payout. So it's I would think in a decently positioned in the sector.
Okay, well, any of the mid-cap stocks, where stocks that we don't normally discuss that catch your eye, beaten down and now showing promise, say Aban, SKS, I mean just anything in that big broad space of non-nifty stocks?
I wouldn't go that much down the quality curve, but I think there are a fair number of interesting companies in the, I would say in the BFSI space. You could look at something like a Bajaj Finserv, Federal Bank, ING. I think the banking sector itself, as and when some of the issues which have plagued the sector start getting addressed, you could see actually a fair bit of re-rating in some of these mid-tier banks and NBFCs.
Okay, well, there was another thing that was just nagging. I've heard a lot of people derating the Indian growth story considerably. The other day we had a guy from the, Velocity actually, from GMO, speaking about the Hindu rate of growth returning. Even other brokerages, JP Morgan speaking about 5% even for FY15, and even wondering whether that will have a downside bias. There are these prognostics. Do you think earnings growth and therefore Indian valuations are under threat, at least now. In fact, there was one analyst who even told us that he doesn't believe emerging markets as an asset class should even be considered. Just some bottom-up stories, but not as an asset class. You put all this together, are Indian valuations, which historically were better than others in the emerging market basket, likely to come under threat?
Excuse me.
I think if, I won't talk too much about what people view emerging markets, etc. But when it comes to India among emerging markets, it's definitely one of the better emerging markets in the sense, despite all the doom and gloom, we are still growing at about 4.4 to 4.7%. If you look at the GDP growth over the last 5 quarters, it's not gone below 4.4%, which is pretty remarkable. So despite all the attempts to damage the economy somehow has some life of its own. Now, the more important thing is, if you see over the last 12-15 months, a number of steps have been taken, and if they are taken, to the logical conclusion, I think this economy can start recovering from fiscal 2016. I think 2015 will still be slow, so I don't, dispute the fact when people talk about 5% growth, even we are looking at about 5.1% growth for 2015. But let's look at all the steps which have been taken by the current government, whether it is with respect to governance, with respect to improvement on the fiscal situation, or with respect to improvement in the investment cycle. Now, the immediate triggers which can drive GDP growth higher would be, I guess, 2 things. One is on the investment cycle. We have already seen a fair bit of progress on environmental approvals for a whole host of projects in the power sector, roads, oil and gas, etc. Of course, money won't hit the ground immediately, so the growth will be somewhat back-ended when it comes to the investment cycle. If you look at the fiscal side, I am pretty positive on an improvement in the next 2-3 years based on what we are seeing in terms of diesel price increases on a monthly basis. And at the point I was making earlier, any new government will probably continue with that. And hopefully, the new government will implement GST, let's say by April 2015. So that could add about, 50 to 70 basis points to your tax to GDP ratio. And similarly, if we continue with the direct benefit scheme implementation, and hopefully you start plugging some of the leakage in the current public distribution system, which could be as high as 40% in case of food grains, 60% in case of kerosene. The fiscal deficit will start improving pretty nicely from fiscal 2016, I think.
Okay.
So I think India is doing all the right things. We are putting in the ingredients for higher growth. Of course, there are challenges. We still need to implement, take this, whatever initiatives have been taken by the current government to their logical conclusion.
Yeah, I agree. I mean,
I won't be as, pessimistic here.
Yeah, no, I didn't mean to be pessimistic. Right. I was just presenting that argument to you, trying to play devil's advocate. Thanks for squashing it for what it is worth. Thank you very much also for joining us today, Sanjeev Prasad, with your thoughts.
My pleasure. Thank you.
All right. You can watch this entire conversation of Market Masters on moneycontrol.com in case you've missed any of the nuances.